Alright students, this is ARD, your accounting coach, and the topic of the day is company accounts. Now you may be aware from your earlier studies that in business there are basically three forms. If we divide business according to their ownership structure, there are basically three types of businesses. First and the most common type is a sole trader. Now, what does a sole trader mean? Sole trader means there is one single owner, or maybe there can be a family who is owning the entire business, and most of the time, the owner or his family is himself involved in day-to-day running of the business. This is known as a sole trader. Sole trader can be as small as a corner shop, or maybe a tuck shop, or it can be a big departmental store as well. So in both the cases, it will be a sole trader. No matter how many employees you have, but if your business is owned by one person or a group of maybe a family, this is known as a sole trader. Then if you want to expand business further, the second option that we have is of partnership. In partnership, two or more persons join hand to make a business because they want to raise finance that is not possible with a single person or maybe a family. We can create a partnership when there are two or more than two. Normally there are 20 partners maximum in a partnership. Now third type that we'll be discussing today is company. A company is a group of people formed with an objective for profit. So there are different types of companies. There is private company and there is a public company. You may be aware of these terms from your business studies. In a public company, the basic difference is that a public company, the ownership can be purchased by anyone from the general public. Means if you have money in your bank, you can buy shares for a public limited company. So a public company is basically whose shares are normally traded on a stock market, that is also known as a listed company in this case. And the capital should be at least $50,000 and the company should be registered as a public company. Now let's see, we are more concerned here with the accounting aspects of a company. First of all, we make an income statement for a company. An income statement which was previously also known as profit and loss account. So I'm not discussing income statement right now because the income statement is the same as of a sole trader. A sole trader income statement ends at profit for the year. It starts from sales, then we deduct cost of sale, then we get a figure of gross profit, then we add other incomes, then in the last we deduct expenses, then the final figure is net profit, which is also known as profit for the year. Now we will only discuss the differences between a sole trader and a company in terms of accounting. The most important difference in income statement is that the interest, whether it is bank loan interest or debenture interest. Now what is the term debentures? Debentures are also a form of loan. So normally if you want to raise huge amounts of money, huge sums of money, which are not possible by borrowing from a single bank, so we will be going to general public for loans. So mostly the loans that are borrowed from general public are known as debentures. So debentures are same as a bank loan and they are paid interest and they are of a fixed maturity, and once that maturity is reached, you have to return back the money from which you have borrowed the money. Normally it is purchased by general public. So debentures or loan interest, this is the main difference in the income statement. Now what is the difference? We will be deducting all expenses as we used to do in a sole trader, but loan interest or debenture interest is not normally deducted in an expense. So what we get after deducting all expenses from gross profit is profit before interest. Profit before interest is also known as operating profit here. So another name for profit before interest is operating profit or profit from operations. Operating profit is more common term in exams. Then, as you are already aware, we have deducted all expenses but interest. So therefore, we are getting profit before interest, and in the last, at the end of the income statement, we will be deducting interest. So how we need to calculate the interest? We need to multiply the amount of principal that we have bought, that means the loan that we have borrowed from the bank or in form of debenture, and we will be multiplying by the interest rate. So we will be getting the interest amount. For instance, we have earned profit that is 100,000 and will be deducting 10,000 interest. So the final profit will be 90,000. So profit after interest is also known as profit for the year. So I hope you understood what is the difference between an income statement for a sole trader and an income statement for a company. There is only one difference, and one difference is that the interest is not normally deducted from expenses. We will be getting profit before interest, also known as operating profit. Then in the last, we will be deducting interest. Then we'll be showing profit after interest. Now, what is the reason for this? The reason is that the shareholders that are owners of the company are aware of the fact that we have earned this much profit, and out of that profit, this much amount of interest is paid to outsiders, that is lenders of the company, that is the creditors of the company, and the final profit that we have saved is profit for the year. So now let's move forward. After income statement, we normally make balance sheet, but in case of a company, we make another statement which is most important, very important, known as statement of changes in equity. Now, what is statement of changes in equity? What is an equity? First, we need to understand what is the term equity means. Equity is the ownership of the business. Equity or owner's capital is what is left in the business after paying off all our liabilities, after paying off all our creditors. Equity or owner's capital or shareholder equity is the residual interest in the business after deducting all of its obligations. Now, we'll be starting with the name of the company. In my case, I've written ARD Limited. Then statement of changes in equity for the year ended 31st December. Whatever date is given in the examination question. So this is the heading. If the heading is not already given in the exam, you need to make the heading as well. So in CAIE O levels, most of the time, the format for statement of changes in equity is given in the exam. But for instance, if it is not given in the exam, you may be prepared to make your own format. Now see, there are different columns here. First of all, there is a column for capital. Now, what does the term capital mean? Capital means the amount invested by the shareholders in the company is known as capital. Now, there are two forms of capital here. One is ordinary share capital and another is preference share capital. Now, let's understand the differences between two of them. Ordinary share capital is the real capital of the business. This means ordinary shareholders are the real owners of the business. So what are the preference shareholders? Are these the artificial owners? These are not real owners of the business. Why? There are certain differences. Preference share capital is known as preference share capital. Why? Because it is being given preference over ordinary shareholders. Now, in what terms they are given preference? In two terms they are given preference over ordinary shareholders. The first scenario is that whenever we need to pay dividends. Now, what is dividend means? Dividend means if as an owner, as a shareholder, you have invested some money in the business, what you will get in return is the return. The return is paid in the form of dividends. Means if I have bought X number of shares for maybe Unilever, so Unilever will be returning money back to me, that is return on my investment in the form of dividends. See, if we need to pay dividend to ordinary shareholders, first we need to pay dividend to preference shareholders. And unless and until we have paid dividend to preference shareholders, we are not allowed to pay dividend to ordinary shareholders. So preference shareholders are given preference in terms of dividend. Secondly, after dividend, if the company is bankrupt or if the company wind up or closes its operations due to unavailability of funds. Do you know when does the company wind its operations, and when is the company said to have been bankrupt? The company is said to have been bankrupt when its assets are lower than its liabilities. Normally, assets are greater than liabilities, therefore, our equity is positive. Whenever assets are unable to cover all their liabilities, this means the equity is negative, and the equity is negative means we do not have enough money to cover all our obligations. This means the business is bankrupt. Whenever business is bankrupt, we need to return back money to debenture holders or lenders first. If some money is left after paying off to our debenture holders or lenders or creditors, we need to pay back money to preference shareholders. Until and unless all of the preference shareholders are given their money back, uh, we are not allowed to pay money to ordinary shareholders. Means ordinary shareholders are always paid last in terms of dividend and in terms of returning back their money in case of bankruptcy. So in both the cases, preference shares get preference in case of dividend and in case of bankruptcy when we return their money back. Now, the question arises, sir, if both of the advantages lie with preference shareholders, why does someone become an ordinary shareholder? Why not all of the people invest money in form of preference shares? Why would anyone dare to become an ordinary shareholder uh, when both of the cases ordinary shareholder is of less advantage? Now, ordinary shareholders have some advantages in himself. First of all, advantage is that they are allowed to vote. Now, what is voting? Whenever company need to make some important decisions, maybe to hire a director, to nominate a director, or to hire some auditors, or to expand business, or to raise finance, there are some important decisions need to be made, basically related with management or audit of the company. So therefore, a voting need to be conducted at an AGM. Now, what is an AGM? AGM is annual general meeting. So directors or management or board of directors of the company call upon all of their ordinary shareholders for a vote. So preference shareholders are not invited to vote because they are not real owners of the company. Only ordinary shareholders are allowed voting rights or voting powers, and they can vote on important affairs of a company. So how is company is managed. So one advantage for ordinary shareholders, they have a voting right, and the second most important advantage is that they are paid dividend, which is not fixed. Means preference shareholders are always paid dividend at a fixed percentage, means maybe 5%. So we need to pay $5 for every $100 capital that we have taken from preference shareholders. But the ordinary shareholders are paid unlimited dividend, and there is no limit as to what dividend the ordinary shareholders can get. Now there are two advantages. So we need to make two columns, one for preference shareholders, one for ordinary share capital, and then we have some sort of reserve. Now, what does a reserve mean? As you are aware that if you ride a bike or if you drive a car, there is a reserve for oil, for fuel. So whenever you drive a car, you may see an indication on the dashboard on the screen, which is yellow mark or orange mark, and it indicates that your fuel is about to end. But it doesn't happen like that whenever you saw a yellow sign, your car stops immediately and you ran out of fuel. No, it's not like that. It may give you an indication for maybe 10 miles or 10 kilometers or 15 kilometers, depending on the size of your fuel tank. So this is known as a reserve. A reserve petrol, a reserve fuel is for emergency purposes, that whenever your fuel reaches a specific threshold, a minimum level, this means now you are using reserve petrol. Now you are indicated to as fast as possible to run to your nearest fuel station and fuel up your car or motorcycle, so because so as to avoid any emergency, so you as to avoid any inconvenience. In the similar manner, companies also save them some money for the future, which is known as reserve. Now there are two types of reserve basically. One is a revenue reserve and another one is capital reserve. Although the difference between the two is only tested as a theory, as a conceptual question in O levels, but in A level exams, this is more thoroughly tested, and the accounting entries are also tested for capital reserve. But in O level exams, the only focus is on the revenue reserve. Now, what is the difference between the two types of reserve? One is revenue reserve and one is capital reserve. You may aware from your earlier studies that there are two types of expenditure. One is capital expenditure and one is revenue expenditure. The concept is somewhat similar. Capital expenditure was an expenditure that is of non-recurring nature, and it is incurred sometimes when we are buying a motor vehicle or when we are upgrading our vehicle in such a way so that its value increases or its life or efficiency increases. It used to say that a capital expenditure. Revenue expenditure was when we fuel up our vehicle or when there is maintenance or repair, that is day-to-day operations in a vehicle. So this is known as was revenue expenditure. Now similarly there are two types of reserve. One is revenue reserve and capital reserve. Revenue reserves are those reserves that are made from day-to-day activities, such as whenever we are earning profit, we are making reserves. Out of that profit we are saving some amount of profit. This is known as revenue reserve. So there are two basic examples of revenue reserve. One is retained earnings and another is general reserve. These are most two common. Retained earnings, what is retained earning? Retained earnings are past profits of the company that are not being distributed as dividend. This means we have saved our profit, this much of amount we have saved from our profit. This is known as retained earning. See, if we give an example of a household, if a household when the father earns maybe 100,000, your father earns 100,000 and give it to your mom, and your mom spends 80,000 out of it and saves 20,000 for future use. This is known as retained earnings. We have retained some of the earnings for a future use. Similarly, we have general reserve. General reserve is a bit similar than a retained earning, and the difference is that we have made reserve for some future purposes. Now, what can be the purpose? As the name is general reserve, means this is not specific for some specific task. There are n number of tasks that we can do through this general reserve. Maybe we can use it to expand business in the future. Maybe we can use it to buy non-current asset or replace our fixture or furniture or plant or equipment. Or maybe we can use it to cover future losses, or maybe we can use it to pay dividends in the future. So there can be n number of uses for this general reserve, and for the retained earnings we are basically use it to pay dividend only, and no other uses are made from this retained earning. Then we have non-current asset replacement reserve. So it is also similar to general reserve, means we have to replace some specific non-current asset which of high value, maybe a plant and equipment. Then we make a separate reserve known as non-current asset replacement reserve, but it is again a revenue reserve. So I hope you understood what does the term revenue reserve mean. Then we have capital reserve. Capital reserves are reserves that are made not from the profit of the business, but from some other some other non-routine transactions. Now, what can be that non-routine transactions? Two examples we have of capital reserve. One is share premium. Now, what does premium means? Premium means extra. You have heard this word many times, that premium chocolate or premium quality product. Premium is extraordinary, over and above the required or minimum quantity. It is premium. So share premium, what means? Whenever company issues shares to its shareholders, maybe we are issuing a share to our shareholders. Now there are some values of shares we need to discuss first. For one value which is most common is known as nominal value or par value. Nominal value or par value, par value of a share is the original value. Whenever the business first issues its shares to public, it is known as original value or nominal value or par value. So most of the time when it is not given in the exam, the most common nominal value is $1. So $1, if the value of a share is $1 originally, but if the company is profitable in the near future and maybe after 2 or 3 successful years of trading, we need to issue further shares. So the share price, that if we are issuing shares of $1 for $1.5, we are charging 0.5 extra. So the extra amount that we are charging is known as share premium, and share premium is capital reserve. It is a gain. And why it is a capital reserve? Because these shares are not issued on day-to-day basis. They are issued on some specific occasions when need money. So maybe at end of the year, or maybe once in a year, or maybe twice in a year. So these are capital reserve. One is share premium, and the second is the revaluation reserve. Now what does the term revaluation reserve mean? Revaluation reserve means whenever see, maybe if we have a property worth $100,000, we have bought a piece of land for $100,000, and the land appreciates in value and it is now worth $120,000. So the 20,000 gain, will be recording the gain as a revaluation reserve, also known as revaluation surplus. We will be making entry land debit and revaluation surplus credit. It is also known as an unrealized gain. Unrealized gain means we haven't yet sold the land. Maybe when we sell the land, the price drops again. But for now, it is an unrealized gain. It is not realized until and unless the property is sold. So you need not worry about the calculation here in O-level exams. But if you are studying for A-levels, the calculation also is part of the syllabus. Now there are two types of reserve. We may move again to the statement of changes in equity. So in O-level exams, the calculation is not tested for capital reserve. Therefore, I have only made the column for revenue reserve. One is general reserve and one is retained earning. But in A-levels, the share premium and revaluation surplus columns are also made. And in the last, there is a total column, total equity. Total column is an option for you. If the format is already given and the total column is made, you need to fill in the values, and if the format is not given, you can also skip total equity column. Now we'll be starting with balance at start. This is opening balance. If we are making statement of change in equity for the year ended 31st December 2017, we'll be starting with 1st January 2017. Now these are the balance BDs, opening balances of preference share capital. This means start of the year, we have this much preference share capital, we have this much ordinary share capital, then we have this much amount in general reserve, then we have retained earnings. Retained earnings are also known as profit and loss account, or they are also known as accumulated profits. Now if we add up all of these, we'll be getting total equity. Now there are some common transaction. One is profit and loss after interest. Where do we get this figure? This we get from income statement. We have already discussed income statement previously. The final answer for an income statement is profit after interest, also known as profit for the year. So if there is a profit, we'll be adding retained earning column, and if there is a loss, we'll be deducting it from retained earning. See, if the retained earning increases due to profit, the total equity also increases. If the retained earning decreases due to loss, the total equity also decreases. See, in the sole trader, as you may be aware, we make balance sheet, we make the equity column such as opening capital, add profit, less drawing. In the sole trader column, we have only one, in the sole trader question, we have only one capital account, and we add capital also in the same account, and if we earn profit, this is also credited in the same account. But in the company, we separate these two accounts. The amount of money that the shareholders have invested in the business come in a separate account that is known as preference share or ordinary share capital, and the money that we are earning from day-to-day activities from our business, the profit is mentioned in or kept in a separate account which is known as retained earnings. Okay. Now if we are paying dividends are always paid with retained earnings, and if we do not have enough retained earnings, we still need to pay dividend. We can use general reserve, but as a second priority. Okay, so first of all we'll be using retained earning and then general reserve if the retained earning has been exhausted. This means if it has been used, and the total equity also decreases when we pay dividend. Now in exam there are certain terms the examiner most sometimes confuses us by saying the dividend have been declared, or dividend has been announced, or dividend have been maybe the directors wish to pay dividend, or there is an intention of the directors to pay dividend, or we have announced dividend or declared dividend. So dividend, if declared or announced, never come in accounts or exams. Never will never be making entry. Only if the dividend is paid, will be writing dividend, will be making an entry. And if the dividend is announced or declared, no entry need to be made. Okay. So after dividend paid and announced, there was one more thing we need to discuss, is that there are two types of dividend basically. One is interim dividend and one is final dividend. Interim dividend, interim means during the year. Interim dividend is a dividend paid during the year, means if our accounting year is January to December, accounts are made after, for December 2017 accounts are not made on the last day. 2017 accounts will be started making in January 2018, and the accounts finalize in 1 or 2 months, and they are audited, and around 3 months, most of the time 2 to 3 months are wasted, spent in making accounts. So if you need to pay dividend, and if you need to pay dividend for 2017, it can only be paid in 2018, means the shareholder need to wait for 1 or more than 1 year in order to get dividend. So as to avoid this problem, we have interim dividend. Now what does interim dividend means if we have passed on a quarter, that is January, February, March have been passed, and we can pay dividend after making an interim accounts, that is accounts of less than a year, maybe a quarterly accounts. We can pay dividend after March, and we can pay dividend, second dividend maybe after June, again 3 months, and then the final dividend comes. Final dividend is always paid at the end of the year. So dividend that is being paid during the year is known as interim dividend, and the dividends that are being paid at the end of the year are known as final dividend. So whether there are interim dividend or final dividend, if the dividends have been paid, we'll be writing here. So most of the time interim dividend for current year will be paid in this year, and final dividend will be paid next year. So for instance, we are in 2017, interim dividend for 2017 will be paid in 17, and interim and final dividend for 2017 will be paid in the next year, that is 2018. But the final dividend for previous year, that is 2016, will be paid in 2017. So I hope you are following these points. Then we have transfer to general reserve. Again, if we need to save money for some future and we need not pay all of the amount that we have earned in terms of dividend, we may save some of the amount in different account, which is known as general reserve. So if you are transferring money to general reserve will be increasing, and the retained earning column will be decreasing. And if you can see, there is no effect on total equity, means if I am taking money out of my right pocket and putting it into my left pocket, my overall wealth does not affect, means neither I am poor nor I am rich. So this is the example for this. General reserve, transfer from retained earning to general reserve. General reserve always increase and retained earning decrease, and there is no effect on the overall equity of the company. Now after these transactions, if we have issued some shares, these can also come here. If we have issued preference share will be increased, and total equity will also increase. If we have issued ordinary shares, again ordinary share will be increased, and total equity will also be increased. And if there is some sort of share premium, again share premium entries are not tested in O level, but in A levels there are always tested. So if we are paying money to if we are issuing shares, maybe $1 share we have issued in 1.6, so $1 will be coming in ordinary share capital account, and 0.6 the extra amount will be coming in a premium account. There will another column with the name of share premium, and the total equity will be increased by 1.6. Now if we start with this opening balance, if we have issued some shares, we add this and we'll get total closing balance. Again in the case of share ordinary share capital as well, if there's the starting general reserve balance is given, we will be adding the amount that we have transferred this year, so we'll be getting the total general reserve. Then again in the retained earning opening, we'll be adding profit, or if there is a loss, we'll be deducting that loss. If there are dividends, we'll be deducting that dividend. Only the dividend paid will come, dividend announced or declared won't be coming. And then we have general reserve. If we have transferred, we'll be deduct this amount, and the total amount will be this. Again this is a total. So my dear students, we firstly discuss income statement of a sole trader, which was almost the same. Slight difference was this in the presentation, and the interest will be deducted at the end of the year and not with the expenses, and the final profit will be profit for the year, which will be added in this column, retained earnings. So we'll be making this statement change in equity. And last but not the least, we'll be discussing statement of financial position, that is balance sheet. So in a balance sheet, as you are aware of the format of the balance sheet, firstly there come assets. There are three columns: cost, accumulated depreciation, and net book value for non-current asset. After non-current asset, we'll be listing all the current assets. Then non-current asset and current asset combines to become total assets. Now after assets, there come capital and liabilities. In the capital section, if we discuss only the capital section, or that of company differ from that of a sole trader or manufacturing or partnership. In sole trader, there comes opening capital, and then comes profit for the year, then we deduct drawings, then comes the closing capital in sole trader. In manufacturing also we use the same format: opening capital, add profit for the year, or if there are losses, we'll be deducting losses, then we'll be deducting drawings, then comes closing capital. In partnership, there comes only two items, that is capital account and current account. If you already studied the partnership, this is also easy. In company, we need to make this format for equity, that is, instead of opening capital, add profit less drawing, or capital and current account in case of partnership, we'll be making this format for company. So now what I have made a statement of financial position extract. Now why does this is known as an extract? Because this is not a complete statement of financial position. This is just part of statement of financial position. So as you are aware, statement of financial position, balance sheet is normally made in three columns. We'll be writing equity and reserves heading first. Equity means the amount that is being invested by the owners or shareholders, and reserves mean the amount that have been saved from profits or maybe some other transactions. Now we'll be starting with the term authorized share capital. Say there is a spelling mistake in authorized. Now what does the term authorized capital mean? Authorized capital is also known as registered capital or nominal capital. Authorized, registered, and nominal capital means the limit of the company, that how much shares the company is allowed to issue to its shareholders. This means it is an official limit being set by a formal document known as Memorandum of Association and Articles of Association. There are two documents that states these such activities of the company. So authorized share capital is being limited by the document, and the document is issued by the government department, that is registrar. So this means this is a limit, the shares that a company can issue in future, and this limit can be increased by some formal procedure. We need to go to the registrar of the public companies, then we need to fill a form, then need to pay a specific amount of money to the government, and then we are allowed to increase our capital. So this is authorized share capital. Authorized share capital is never added in balance sheet, so we just need to show this carry 1 mark in an exam. We need to just show it. If there is preference share capital, we will be writing this, and if there are ordinary share capitals, we will be writing this, and we add up and just keep it here. We will be not carrying forward this amount to later balances. Then we have issued, called up, or paid up share capital. Now there are slight differences between these terms. Issued share capital means the amount of shares actually issued by the business. Means if there is a limit of 100 million shares, this means we do not need to issue this much amount of shares right now. This means out of 100 million shares, the company has issued 60 million. This is known as issued share capital. Now if we have issued 60 million shares of $1 each, this amount to $60 million. But right now company does not need this much of amount to run the business. We only need maybe $40 million right now. The amount which we have called up to our shareholders and the amount that we are asking our shareholders is known as called up share capital. And if we have called up 40 million shares or 40 million dollars from our shareholders, the shareholders should also pay us the same amount. But there can be a situation, some shareholders have some temporary financial problems, short-term problems, or maybe some of the shareholders are out of the country and we cannot contact them due to some reason. we can get the amount that the shareholders have paid us, and which is known as paid up share capital. Maybe out of the 40 million we get 38 million right now. This is known as paid up share capital. Paid up share capital, the actual amount that the company has received from its shareholders for the shares issued to them. And $2 million will be waiting for some while, and if the shareholders give in the time limit, so they will be converted in a paid up share capital. And if the shareholders are unable to pay us the amount due to them, so due to us, so we'll be cancelling these shares and reissuing to some other shareholders. Now for calculation purposes, these are all mostly the same in the exam, but in theory question it can ask, the examiner can ask the differences between the two or the definitions of two. Then we'll be writing preference share capital, whether it is issued, called up or paid up first, and then ordinary share capital. Then after capital we'll be writing reserves. There is general reserve and retained earnings as revenue reserves, and there can be some capital reserve in case of A levels, that is share premium or maybe revaluation surplus. Now if we add all of these, after adding all of these, we will be getting total shareholder fund. This term is important. Examiner usually give 1 marks for this labeling. Total shareholder funds, any label other than total shareholder funds is not accepted in exams. All of these will be adding this capital, whether it is preference or ordinary, and all of these reserves, the total is total shareholder funds or equity. The balance sheet extract is normally till here, and after that we usually write liabilities, non-current liabilities and current liabilities. Then in this question, sometimes the examiner asks for a figure of capital employed. Now you are aware capital employed is the total amount invested in the business either by the shareholders, that is owners, and also by outsiders, that is lenders or loan providers. So if we add up debentures or bank loan in this total shareholder funds amount, we'll be getting capital employed. So capital employed is the total amount. So capital employed, only need to calculate capital employed if asked by the examiner. If not asked, we'll be keeping it here till total shareholder funds. So I hope students I was able to explain you the concepts underlying company accounts. I tried my best. If you like the video, kindly comment. And also subscribe my channel if you haven't subscribed it yet, and do share these videos with other fellow students. Thank you ji.